So once again, we welcome you. We totally believe that one of the things that need to start happening is the fact that we Nigerians should start taking full advantage of all of the resources we have available to us, especially in the oil and gas industry. We know that for a fact that virtually everything that is being traded right now, when it comes to oil and gas trades, that we don't even have any part in it. The prices are determined by traders abroad. The sales are done, but we are the ones that are producing the raw materials. But one thing I found exciting is the fact that there are a lot of Nigerians who are also in that space. We are seeing quite a few people who have been doing something in terms of playing in the oil and gas market, even if it's on a derivatives level. And that is one thing that we felt that we need to bring to the attention of everyone who is associated with us in one form or the other, to expand it and show you that there's something actually happening in that market that we can actually take part in. So it's actually a pleasure for me to introduce someone who has proven to be a major player in that market. He is a trader, seasoned institutional trader and entrepreneur. He has trained a lot of people in terms of trading and other issues that has to do with entrepreneurship, especially as it relates to being able to actually earn an income online. He has facilitated several programs, both within and out of the country. He has just recently run a program for the Chartered Institute of Nigerian Stockbrokers and also for the Lagos Futures and Commodities and Futures Exchange. He's a full member of the Association of Nigerian Commodities Broker, a very senior broker with an international firm. He is specifically trading in oil and gas futures and has had limited and very good success, and is about to share with us what is actually happening in the derivative space, how are people going into that space, what it actually takes to be a player in that space. So he's a trader for an investment and trading firm called ICC Traders, and he's going to be joining us all the way from their UK office. So please, I know we're not going to spend too much time. It's my good pleasure to introduce Mr. Uche Paragon. He is the one that is going to take us through this entire program, and he's going to show us the insights that we require in terms of derivatives trading, especially as it relates to the oil and gas sector. So please, with all due pleasure, let's welcome right now our facilitator for today's program, Uche. Over to you, sir.
Hi, good morning. Thank you, Mr. Nnamdi and GTI Finance Academy. I hope everyone can hear me. If you can hear me very clear and can see me very clear, you could just type 1 on the comment section, so I'll be able to know that I'm kind of interacting with you. I'm seeing quite a number of people here. Mr. Andrew Kasmel, Chika Okoro, Follow, I'm sorry if I pronounce your name very wrong, pardon me. Follow Abejangiri, Godwill Osofo, Nnamdi Obi, Olowafemi Bakere, Tinji Karen, Vitalis, and so many of them. I welcome Manuel and so many of them. In case I didn't call your name, I can all see you in attendance. And Sadiq Ibrahim. My name is Mr. Uche Paragon. I'm a commodity trader, and I've been trading for quite a number of years now, average 14 years now in trading. And I was privileged to start trading with institutions. That was one big advantage I had. I'm so happy with what GTI is doing. Like the bigger players in African industry coming into the derivative space, bringing the awareness and the education to the people. Because as I always said, we are the people that are supposed to champion this cause, not the boys in the street and the people who are not even capable enough to carry out this business. For example, in Nigeria, anything digital, fintech, innovation, whatever thing is left for the boys. And boys does not even have enough money, and sometimes it is subject to abuse. Even some regulators or some authorities are not even more strongly involved in it. So they left it for the boys, and that's why we see a lot of abuse in the system. But the same business that is being abused in a part of the world is also business that is driving the whole world in a particular direction. So I will be sharing with you on. I've already done the slide, and I'll be teaching with you on derivative, oil and gas derivative. I'm going to share my slide now. I think I'm the host now. I can be able to share my slide.
Yes, you may. Please go ahead.
Yeah, oil and gas derivative. Just give me some time, let me get it done. Yeah. So if you could see my slide, you could just type yes, it will help me. Yeah. Slide. Yeah. I hope you can see my slide over there.
Yes, we're good, sir. Please go ahead.
Yes. So the purpose of this class today is to like create the awareness to some people who have probably heard about it or doesn't know how it works or have negative perception about it, does not even know exactly how it is being played. So we are going to teach on crude oil and futures, crude oil futures and derivative. We call it energy without borders, because a lot of people who plays in oil and gas industry think it's only about working with NNPC, import and export of oil, or working with oil and gas sector, being in the rig. So they actually know. So that's why we call these things energy without borders. They don't know what how we can actually utilize the energy sector and be able to make profit. People always know that it's a business that is being run globally. People does import and export, but of course you know that the public there don't even have access to the commodity. Now the objective of this class now, at the end of this teaching, we will focus on what derivative investment is, how oil futures and derivative is traded, the profit and the risk, and how you can get started. So this will be my objective, to let you know what you'll be getting at the end of the class. What is derivative investment? I'm sure it's also recorded. You may be able to ask for the recording, or you can also have your own personal record, so you could listen to it over and over again. What is derivative investment? How is oil futures and derivative being traded? And profit and the risk. Then how you can get started in the business. Now, actually, what is derivative? That is the first place we will focus on. I've already made my lecture to be in two sections. I will explain derivative. I will explain to you oil futures. Then I will now explain to you how it is work. Then I will now let you know how you can get started. You will get all of them in this lecture. So please just bear with me and take it bit by bit. I will try as much as possible to be very simple as possible, so you could be able to understand deeper how it works. Now, this is from Investopedia definition of derivative market. It's a type of financial contract whose value is dependent on the underlying asset, group of asset, or benchmark. This definition is just like an overview, a simple definition of derivative. Now, another deeper definition about is that derivative is a financial contract set between two or more parties that derive their values from the underlying asset, group of asset, or benchmark. Now, mark the word underlying asset. Underlying asset means probably a phone or oil or any product you could see, maybe a car, but you could see the price of the car online. So the price of the car you see online is actually derived from the car that is being parked in a car garage or being produced in a car company. So the car is somewhere parked somewhere with a car dealer, while you could see the price online, probably on Gigi or any other e-commerce website where that car is being sold. Where that car is being sold. That is what is all about derivative. I got a detail from my moderator that I should change something. I hope it's okay now. Let me get the feedback from you. I won't mind hearing your voice because it have to be interactive.
It's fine now. Thank you.
Yeah. Did you see from the beginning, or you're just seeing from here?
It's fine. It's good.
Just okay, shall I start from the beginning?
No.
Okay,
no,
perfect.
Go on, please. Yeah.
Okay. Now, I've explained the first part of this derivative now. Another derivative can also be traded on exchange or over the counter. Exchange means a commodity exchange, a stock exchange, or a mental exchange. That is where derivative is traded. I trade on Nigerian exchange. I trade on 2 major exchanges in Nigeria. Since I trade, I don't always take delivery. Now, prices of derivative is derived from the fluctuation of the underlying asset. Same way I explained to you from an example of a car that is being parked in a garage. Well, so you may come in, discover that today the price of that car is 12 million, and tomorrow the price may be 15 million. Now, the prices, what determine that price could be a lot of factors, custom duty, different kind of things that may be exchange rate that can affect the price of that car that dealer packed and position for sale. Now, it is being derived from the value. It's not based on something you see somebody changing it on internet. No. Derivatives are usually leverage instruments, which increases their potential risk and reward. Now, even in the spot market now, most spot investors who does not use leverage product are also taking derivative aspect. Now, common derivatives include future contract, forward contract, option contract, and swap. I'm sure this last one is very familiar. This is definition from Investopedia. You could be able to access it from your own side. So you could be able to see that the last one, I think we are familiar with it, like about future contract, forward contract, option, and swap. However, in Nigeria, the future market is not really well developed. It's not that it's not there, but there are some exchange there who plays on future market, but it has not been fully developed. But there are a lot of challenges that is affecting it, which we will discuss here further, probably in our question and answer session. Now, this is derivative. We are going to focus on oil future because virtually every asset classes can be done only either on future, spot, option, or swap, and also derivative. So almost every asset classes you're trading, there could be derivative aspect of it. For purpose of this lecture, as we just said, we will focus more on oil futures and derivative. Now, in the oil market itself, is one of the best commodity anyone can trade because it is very active. It has a very much investors globally. All of us know that everywhere in the world, almost everywhere, you hardly see a country who does not have a stake in oil or who does not use oil product. It's also a commodity that is being known everywhere. Now, the price of crude oil also affects the price of every asset classes. Nigeria is having a problem now domestically. That's, let's say, not a global crisis anyway. I would say domestic economic crisis. The problem is that the price of produced product like PMS and all that has gone up. And now, why did it affect every other thing? Because the price of those products affect the price of every other economic activities, like people who want to run their factory, who want to go somewhere, who want to do a lot of things, needs that commodity to power up the activities. So now, because they could not get it at a cheaper price, the driver have to increase his own price. The person who sells in the food market have to increase. A lot of them have to increase because the price of oil globally and locally affect the price of every other thing you are doing. Call it currencies, call it gold, call it stock. The price affects it because the oil still remains the major source of energy around the world. Now, another thing too is that you can hardly see where there is no news about energy market. Even when you tune up to your local radio station, after the news, you see that they will start giving business news concerning the market. When you talk about stock market, they're most likely going to talk about oil market, telling you that where Brent crude closes at so dollar per barrel, this one closes at so dollar per barrel, this one open at so dollar per barrel. That's always a news. And again, those who trade in this market are mostly rich people. Unfortunately, some people who trade in the market in Africa are the youth. Some of them don't even have enough money to do it. It's a business that is mainly for the rich, and also a business that if you are not rich and come into the oil and gas sector, no matter where you are playing, whether you are playing on future or derivative or whatever, you will have the chances of becoming rich. Now, who can trade oil? I'm so sorry. In case you have a question, question can slip your mind and everything. Just be writing it down, so you won't be able to forget the questions. Who can trade oil futures? Because it may look so broad and something that is not closer to you, something that's too far from what you think it is. You as an individual can trade oil. A corporation can trade oil, or a trading firm can trade oil. An individual is easy. A corporation is very much easy. A trading firm is also very much easy. Now, professional traders and hedgers dominate the energy market, with industry players taking position to offset physical exposure, while hedge funds and retail traders trade on a long and a short-term price direction. Now, hedge fund retail traders, I also include like trading firms or individual traders, brokers. They also trade on the same direction. There are so many players who plays in the oil and gas sector. So many players who play in oil in the sector. Now, let me make a little emphasis on future contract and spot contract. Most people don't understand the differences of spot and future. Oil is traded either on spot contract or future or derivative contract. That is why you cannot go to Alaba market and see crude oil in there. You cannot go to maybe Balogu market at Lagos Island and see somebody who's trading oil. No, it's traded on either on future contract, spot contract, or which is also part of derivative contract. Now, future contract and derivative is done through an exchange. It's done through an exchange or a dealer, which is also known as commodity exchange. It's not really mostly done on stock exchange, but there are some exchange in the world that allow future on oil derivative. Someone is sending me a chat. I may not know. Please, I say jot down the question so that I won't be interrupted. Now, the spot contract is example of the parallel market. Let me emphasize on what we call spot. When you say that something happened on the spot, it means I want to buy a phone, and I went to the phone dealer, pay a price for this phone, and the phone dealer gave me this phone immediately at the spot. That is called spot contract. Sometimes, even if I'm not buying immediately, even if it's not going to deliver to me immediately, I may lock up a price. Maybe this phone is selling at 200,000. I'll probably call him on phone, pay 200,000, and keep the phone for me. Any day I'm free, I'll come and take it. That is spot contract. So it's an example of black market business. So you could see that in black market where you go into a boutique, you buy a cloth, and you pay for your cloth, and they give you the cloth. That is spot. And future contract is similar with derivative. So there's no much difference, because they mostly don't take the physical delivery. So when we say come and understand oil future, we're not trying to tell you to build an oil farm and build a lot of big tank and where they will send you crude oil and you began to like refill it. Even if you do that, it may be useless, because you may not be able to have refinery where you refine them, or whatever you're going to use them to do. And you most likely need to go in for contract, for license and everything. And I will not say you are an oil investor, because it's a different part of business. So it's totally different from when you are trading it on the values or on the future or derivative contract. Now, how big is oil derivative market? How big is this? The global oil, the oil is a global asset. It's something that is globally regulated. And investors who invest in this industry invest through a different intercontinental exchange, or dealers and liquidity providers. Now, this process is also known as across-the-border derivative. Now, let me emphasize something on this. Almost virtually everything we do in this world today are connected to the global village structure. I was speaking with someone, and I was telling her on the radio in Nigeria why Nigerian education system is having a challenge, and a lot of businesses are crumble, because digitalization is changing and has already disrupted the way we do our businesses, the way the economy of the world runs. I give her an instance about education, how digital technology has disrupted the educational system of other countries who failed to leverage on the digital economy to run their educations. Some countries build digital infrastructures for education, and they could be in their own country and extract student from another country to their own country and make billions of money from it. That is digitalization. It's also what is called across-the-border education. Everything now is connected to the same way. So in my house in Lekki, one of my neighbor was a student of Harvard University, United States, and he lived with me there. He said he doesn't want to go there because he subscribed for distance learning, and he was doing his master's there. That is globalization, and there may be hundreds or thousands of them who are in Nigeria, who are also a student of Harvard or different schools across the globe, and they pay a lot of money to this school, to those institutions, and they make a lot of money. It is global educational system. That is the seminal thing, that let's say education become a stock. Education now become a global stock. It become an entity. It become an asset where people can picture or envision education as a stock or a commodity. So you become a global commodity. Now, the similar thing you see in oil is a global asset. And investors who invest in this industry invest through different intercontinental exchange. When I mean by intercontinental exchange, there are a lot of exchanges across the globe, just as we have a lot of investors across the globe. You see, for example, let's start from Nigeria. Lagos Commodity and Future Exchange, London Stock Exchange, New York Stock Exchange, the Singapore Exchange, different kind of exchange across the globe. Now, digitalization has connected these guys through like a global chain network. Like when I was in Lagos Commodity Exchange, one of the directors was saying one of the plans they had was to know whether they can connect API from their own server to Bloomberg, and from there they get API that can connect to other London Exchange, Dubai Exchange, and I think Mauritius Exchange. So where they could be able to be in their own exchange and see a product that is listed on London Exchange, I can be able to buy them and sell them. Or somebody who traded on London Exchange could be able to see the product listed on their own exchange and be able to buy them. That is connecting the global commodity, global instrument to one platform. And then now, anyone who does not understand how these things work will fail off. That's also one of the reasons why we keep making sure that people understand how money is made now. Some people are in their country, but what gives them money is no more in that country. It's a similar example of what is happening to Nigeria, where there is no more global businesses where they can be in their country and make money from the global community without having to be there. Now, there are some factors you need to know, because I believe everybody here may be new to this business. Factors you need to know that affect the price of oil, which is a very much important factor. And on this particular section now, I would like to be very much lively with you, where we can be able to interact One of the factors you need to consider in oil and gas, or the factor that affect the price of oil, is demand and supply, politics, and natural disaster. There are other ones, but these are three major factors: demand and supply, politics, and natural disaster. That is also why it's a simple commodity to trade. Try to take down that note. It's a simple commodity to invest, or a simple commodity to trade. Demand and supply, politics, and natural disaster. Now, let me explain more on this. In a demand and supply, there's a body we call EIA, Energy Information Administration. Once in a week, they give us, there's also another body called API, American Petroleum Institute. So they give us a glimpse of what the future price of oil is most likely going to be. How? By releasing their crude oil inventory report. This report involves the total quantity of oil available for trade globally. I told you before, it's a simple commodity. Now, demand and supply. Now, check my last statement. I said this report involves the total quantity of oil available for trade globally. Now, since it's a global commodity, it's regulated. So many players in the industry are mostly government, and we also have other body called OPEC and OPEC Plus. They all regulate it. So the market is a regulated market. It's not unregulated market like crypto market. Then, so it's easier to know the quantity of oil available for trading globally. And the body in charge of this report is EIA. There's also another one. If the quantity of supply is higher than expected, the oil price is most likely going to drop. Those who did economics, you understand demand and supply metrics. Then, if the supply is lower than expected, the price of oil is most likely going to rise. This makes the oil market or oil price easy and very much predictable. It's very much easy. The same money you make in shipping the oil, you may make more money when you trade it on the derivative. I can tell you the truth. You don't need to pass through that processes. Now, when you see a demand of oil, okay, let me give you an instance. About 3 or 4 weeks ago or a month ago, Saudi Arabian and some other OPEC community agreed to cut production by 1 million barrels a day. I think Russia also supported the cutting of that production by 1 million their own barrel a day. The Emirate Prince also supported the cut of production, and they make it clear that they want to stabilize the oil price at $92 per barrel. It's easy. We have already known what they want to achieve. Unlike stock, where it's difficult to predict what is happening. They have already make it clear to the global community that this is the price we want to put. And if you check it very well, every country in the world, including Nigeria, has a benchmark. Check browse Nigerian, do your research on Nigerian economic forecast for the year. You may see that they have a benchmark of oil, what they want. So anything above that could be excess crude account, could be excess crude money. Now, OPEC and OPEC Plus also regulate this price, or they also regulate the supply quantity among other members. Many oil producing countries also set their own oil price benchmark. This is another easy factor that makes it easier for people to make profit in the oil and gas market. What I'm trying to explain to you is that if you are an oil investor or an oil trader, you may not need a third party to make analysis for you, because the information is with you. It's easy for you. You may not need so many research analysts or so many market analysts or financial analysts to start making prediction for you, because this is something that everywhere on the headline is there. We all know what is happening in the sector. It's like the black gold of any country. And it's one of the biggest commodity market, I can tell you. One of the biggest commodity market. Now, we have two types of oil that's very much common. There are other ones, but the two major one is Brent crude. In this Brent, there are a lot of Brent inside Brent. Then we have WTI crude. Brent is traded through through Intercontinental Exchange, And the light crude or WTI crude traded through New York Stock Exchange. That is the two major exchange where this market is being traded. How it is done? Why is it traded? What do I mean by that? That is where the prices are decided. Like gold, the price of gold is decided by the gold there's a community in London that decide the price of gold, that fix the price of gold. Now, the price of these two instruments, or the major places where the major market signal come from on Brent is Intercontinental Exchange and New York Stock Exchange. Now, what is Intercontinental Exchange? Is different kind of exchange across the globe. During the pandemic, you may check some dealers or some exchange. You may see that the price, some of them we are trading at $10 per barrel. Some exchange we are trading at $5 per barrel. Some close at $15 per barrel. Some exchange trade at -$5 per barrel. That time we did a video trying to let the world know that oil has gone below risk level. There's nothing to risk again. So if you want to invest in oil now, go and invest. Within 21 months, the price of oil rose from $0 per barrel to $129 per barrel. These are investment opportunities that can make anybody rich, because it's a very active market. Now, this intercontinental exchange have their different prices. That's also why sometimes Brent used to have more volatility than WTI, or like say there's a little different in price than WTI. Now, the benefit of oil futures: one, it's a physical commodity. It's easy to gain and predict, like easy to make gains and predict. It's easy to determine the quantity of supply and demand. Then the price of oil itself is regulated price. Access to oil can be done through a commodity broker or an exchange. It can be done through a commodity broker or an exchange. So these are the benefits. One is something that is physical. I listened to a video, I read an interview of Bill Gates, why he refused to invest in an NFT, doesn't want to invest in an NFT. Why? He said that it's an intangible product, and it's too volatile. So he wants something that is a little bit tangible, like a tangible asset. So it could be a hack that digital image is not enough to form an asset class. He wants it to be a little bit tangible. Those who invest in crypto is not a physical commodity. It's a digital commodity and digital product, which is not even regulated, and it's difficult to predict it. I can tell you the truth. But oil is very much different from any other asset classes you may ever think of. Now, let me give you further analysis about how the global industry plays in this market. People who are involved in this business. We have investment bankers. Then we have brokers. We have individuals like me and you. We have private firms. We have hedge fund. Then we have liquidity providers. These are people who plays in this market. We have investment bankers, brokers, individuals, private firm, hedge fund, liquidity providers. Take note of these liquidity providers and broker. I will explain more to you how they interact, they work, because there was a time about 6 or 7 years ago, somebody asked me, when you make money from all these things, who pays the profit? People need to understand the structure, how it is being structured, which I'm most likely going to let you know. Now, this is how order is executed in the market. Now, check the first slide. I've changed a lot of things. Now, I put only 3 things here. Investor, which is individual or company or bank or whatever. Anyone can be investor here. Broker or a trading firm, second. Then liquidity provider, dealer or exchange, the last. Now, why do I keep mentioning liquidity provider? When it comes to derivative, it's a business where you don't take physical delivery. All the profit are paid in cash. Now, instead of a liquidity provider or a dealer to send you a tanker full of crude oil, the value of that crude oil is already in cash. It is paid to you. So cash value now represents the contract or the quantity. And now this cash value is mostly domiciled with liquidity providers. Exchange does not play a strong role, because even an exchange, Exchange just provide the market where you could match a buyer and a seller, and inside that exchange, there's also someone who provide liquidity. Liquidity means who provide the capitals people are trading on. It's called liquidity providers. Now we have dealers too. Dealers could also serve as liquidity providers who make some underwriting of the asset classes and whatever, according to what they want. Now, the broker or trading firm are the one who make executions. If you Google the definition of a broker is someone who execute order on behalf of client or company, whatever. We have real estate broker and commodity broker, stock broker, and different types of brokers, insurance brokers. So a broker or trading firm are those who make executions. In some exchanges or some dealers, if you're not a dealing firm member, you won't be able to trade on their exchange. Some liquidity providers, if you're not a broker or a very detailed person in trading industry, they won't be able to give you an account to trade. Like they won't be able to open an account with you. So most liquidity providers does not deal with investors direct. They deal only with brokers and big firms. While the investors, individual and another company connect to themselves to the broker, then the broker make execution for them. Of course, on a charge. This is how the order is structured. It's similar when you want to buy a share. You can come to GTI Asset Management or Brokerage Company. They will give you the list of all the shares available in all the market they have access to, in case they have more than Nigerian stock market access. They'll give you all the list of all the shares. Then you ask them to buy. You make probably an order. Then they have to buy for you, either from the price you want or from the market price. So it will be the work of GTI to make that execution. Then you will see that order has been executed and you see a contract note and everything. That is how trading industry is structured. Now, people who make or who pay profit, who people trade on, are majorly liquidity providers in the derivative market. Take note of that. People trade on, or the company that provide the fund. When you hear about $2 billion, $20 trillion being traded, that money is majorly connected to different liquidities and dealers that you are making those execution on. They are the people responsible, not your broker or your trading firm. Now, all this money runs in big liquidities that can be like inexhaustible liquidity. That is difficult for one person to like exhaust it. There's no amount of money you may want to gain in the market that you can liquidate. And some of these liquidity are also run in aggregated or aggregation, where they are connected to several liquidities. Liquidity 1 will connect to liquidity 2, 3, 4. This is the power of digital technology, where you say one liquidity may have several other liquidity that he connected to hedge against risk and market fluctuation. The same broker may have more than 3 or 4 or 5 liquidity that he connected to. So it doesn't make execution on one liquidity or one exchange. Like GTI now may be a member of Lagos Exchange, maybe a member of Nigerian Commodity Exchange, maybe a member of FS Exchange, maybe a member of London Exchange, maybe a member of New York Exchange, different kind of exchange they are connected. Now, may also be a client of different liquidity providers across the globe where they have access to. So now, when you want to make execution, then make this execution on those liquidities. And that is how it is structured. Some other investors too may also be able to do, but it's difficult. Forget about the trading platform where you make that order. At the back end, what actually happens is that you have given an instruction for your broker to execute an order. That is how it works. Now, let me go deeper about oil profit. The derivative market is said to be over, I'm sorry if I can't pronounce this very well, over $4 trillion. I'm so sorry if I can't pronounce it very well. I can't pronounce it because of my voice sound. Over $4 trillion in notional value on the high end. But some analysis also say that the market is grossly overestimated. This is from Investopedia 2022 publication. Now, in the CME, you know, anybody who are into this business knows CME. They are connected to New York Stock Exchange, one of the biggest derivative market in the world is CME. They have over 1 million contract of WTI future and option traded daily. with approximately 4 million contracts of open interest. This is this year, each day. CME has over $1 million contract. We have account with them anyway. Now, the global derivative and commodity brokerage brokerage market is expected to grow from $437.93 billion in 2022 to $469.30 billion this year, which is 2023. Now, the Russian-Ukraine war disrupted the chances of global economic recovery from the COVID-19 pandemic. These are information, our current information. This one came from Yahoo Finance. So you will see how big both the brokers who play in the industry, the kind of volume they control. These are brokers, the kind of volume they control. On the commodity derivative market, the biggest one we have CME, the kind of volume that is being traded in 1 day, 1 million contracts in 1 day. And the kind of estimated market value or overall value is more than, I think, 4 trillion could be bigger than trillion. It's a one continent. I don't know how to explain this, but the market is actually huge. It's a very big market. This is what technology did for us, what the global market did for us, what makes it easier. So if you want to succeed in this life, you don't need to be looking for Alabama market to make money or local market or on the road. There are a lot of market floors where you could be able to be in the country where you are and make good amount of money. Now, in our firm, let me just give you an instance. One of the firms we deal on, between 2021 and 2023, we made over $8 million profit. This is just one, because there are thousands of them, more than 4,000. So if we to we didn't get maybe proper audit on different this thing. So if we are amount of money that you would doubt whether it is real or not. So this is the profit between 2021 after the pandemic and now. This let's say about 2.5 years trading on one portfolio. Then if you check other portfolio, that is how it counts. It's more than 4,000. This is kind of profit you could make in the trading. Then imagine those big firms who are very much big, who have big clients, who have big traders who are under them, the kind of money they are making. You ask yourself, this money, is it Nigerian bank that pays the profit? No. Is it coming from a Nigerian company? No. Is it coming from a company in the New York? No. Is it coming from? It's coming from different liquidities. So you could come from liquidity in Dubai, where you are making your order. You could come from liquidity in the United States. You could come from liquidity in London. You could come from liquidity in the EU. So where you make the your order, because global system have given us access to the global market, where you can be in your country and own shares or to play on different market across the globe without you having to travel in there. Now, how you can get started? This is another segment in this business, is that access to oil futures and derivatives is done through your broker, who execute the buy and sell order on your behalf on different liquidities and dealers across the globe. You may only need to have an oil trading account with them, and that's the only thing that you need to do. There's no much paperwork. Most investors don't take delivery, even in future contracts. If you do your research, people who trade on future contract don't also take delivery. Everybody take cash settlement, because investors are more concerned about the cash value. They are much concerned about the price which they bought and the price which they sold. They're not concerned about the volume, about the product. It's only the companies who are like maybe refining company or countries who want to export it to the country that will refine it, that will ask for delivery. Let's say Dangote refinery. If Dangote want to buy oil now to refine, he may not go to the creek to buy it, and he may not buy on derivative level. He may most likely come to the exchange and get a dealer that will sell the oil to him. Then they will now export it or transport it to his refinery, and he will refine and sell. I don't think he may just enter the Niger Delta Creek to buy oil. It may be from an organized exchange, why we have all these things. So now, on that note, he may trade on the future contract. So he may have a deal with a company, like a drilling company, to produce a certain quantity of oil at a certain date. So the price will be locked and delivery date will be locked. That's agreement between two parties to transact, to trade oil from a starting date and to end date. Because I told you it's done on contract. But on derivative, when the end date, when the contract expires, there's automatic rollover. So they will ask you to, since there's no delivery, so they will roll over the contract automatically. Those of us who have been here, you will just get a notification when the contract is going to expire, and automatically the next 24 hours we see an email that it has been rolled over. Then the price continues. So it's not that the price is going to end, because the market price is like an infinite price. It continues. Now, about regulation, people may be asking, how does this work? The derivative market is mostly self-regulated. Since the digital disruption have disrupted the traditional exchange, most exchanges around the globe have gone digital without a central exchange anymore. According to research, the London Metal Exchange is the only physical existing exchange. Now, what I'm trying to explain here is that the regulation of this market is mostly done on self-regulation. It's no more done on central regulation, because of digitalization have changed the way business are done. People are even working in a remote office. People does not come like a physical place now and do business. When I was there was time I was with London Lagos Commodity Exchange. I think they made a comment. They sent team of delegates to South African exchange, I think, to make a research, only for them to get there. They didn't see anybody. They only saw big screen on the wall. They see market prices changing. So when they ask question, they were told that many brokers who trade, or many people who trade here, are not trade in their houses, so they don't need to come here to trade. So this is just like administrative. On London Stock Exchange, if you go there, you see that some of them have converted the offices, like you could use it to do seminar, do program, do a lot of things, because many traders are trading from their home and offices. Now, and that has given rise to self-regulatory. It's no more central regulatory, because it's becoming a challenge in Nigerian market, like navigating to self-regulated. They still want to have issuer, want to have settlement, want to have the one. So it becomes a very complex situation, especially if you want to implement the derivative market. And the derivative market cannot run only on a national market. It can only be run easily on a global market, where you have an intercontinental connection between exchange and exchange, a dealer and a dealer, derivative and a derivative. So the self-regulation is the major concept of regulation or regulatory structure. The trading firm can only be doing reporting to the regulator, what happened to the company and everything. So the regulator have to set up the compliance officer, set up the trader, set up all the terms and conditions, then and be able to make carry out their order. Finally,
you have a few more minutes so that we can go into questions now.
Yeah. Finally, the trading in crude. Trading crude oil is an energy market, requires exceptional scale, set to build consistent profit. Market players is looking to trade crude oil future and its numerous derivatives need to learn what move the commodity market. Now, the nature of this prevailing crowd, the long-term price history, and the physical variation between different grades. So this is another thing I want to also let you know, that we are also moving towards bringing in derivative that is back with real gold, because the digital gold has come into place, and the market value is also changing, where different kind of derivative asset class is going to be merged with itself, where you could hedge your parameter asset classes and derivative. You could be able to interact with all of them. Like as I said earlier, almost all the instruments you are trading have derivative aspect. I'm gradually coming to an end. So this is the end of my lecture. If you have any question, I'll be able to attend to the questions, me and my moderator. Thank you so much.
Thank you very much, Uche. That was a very incisive presentation. We really appreciate your time and the in-depth of the research, which has covered quite a lot. And most importantly, I think it has given us an eye-opener into the fact that I, as an investor, can actually play in this market through a broker, now linked to the liquidity providers. So, and the market is so huge that it's quite accessible. So I want to thank everyone who has joined us. And while we're still doing the summaries, please, if you have questions, you can actually put it on the chat box right now. We'll allow some people to have access so you can actually ask the question personally. But before you can do that, you can please indicate by raising your hand, and then we'll get to you. But over this lecture, what I have learned primarily was the fact that as the oil market is backed by the derivatives that have been done all over the world, you actually have a physical commodity, like Uche has called it, that you can actually use to determine the price. And that is one thing that is very essential when you are a trader, from what I believe. Being able to know when the price is going to go up and when the price is going to come down, and being able to actually determine the fact that you can take a position at any point in time. That does not remove the fact that you need to learn. And that's one of the reasons why we at GTI believe that we need to bring some of these seminars as regular as possible to expose us and also to give us the opportunity to learn how to do some of these things. We thank you, Uche, for your presentation. We intend to run this for the next 15, 20 minutes. And we want to be out of here by 11:30 at the most. We know people are pretty busy. So let's interact with him. He's joining us from their London office. So we appreciate your time, Uche. I have Mr. Andrew. Mr. Andrew, you have the platform. Please ask your question.
Thank you very much. Which I would say your presentation is, let me say, academic. But you know, we really need to know exactly how this industry plays, how you can play there. But what I've been able to gather here is that you cannot play without the help of a broker. So who is doing the job? Is it GTI or is it you? Thank you so much. Because I'm interested in this presentation and I also want to learn. Thank you.
Thank you very much. Mr. Uche, please, can you put down your slide? You're still sharing your screen?
Oh, stop sharing.
Okay. Yeah. And also, you can also take this question. It says, what are the factors that determine the oil price movements? So you can handle those two questions at the same time.
The factors was here. I shared the factor here. Before we told you demand and supply, politics, and natural disaster. They are the major factors that affect determines the price. When there are more supply from the EIA, the price of oil will rise. I said it here. Let me know if I can get it again. Demand and supply, politics, and natural disaster. Yeah. So when there are more supply of oil, the price of oil is most likely dropped. When there are lesser supply, the price will go. This is just the major factor that affects every business. Then politics, of course, OPEC, the politics they play in the oil industry. Natural disaster, you know that one. When there are issues that affect the oil rig and refining company not able to work or stuff like that, it could affect the price. Or war. When there is war in some high oil producing countries, it could spark the price of oil mostly to rise. Yeah. Which other question?
The question on how somebody will enter into this market. Is it going to trade or how is it going to work?
Derivative is not a spot market. We have explained that. So you can't trade oil physical unless you want to do import and export of oil, which will require you to get a license to do all these things. Now, if you want to be an oil investor or trader, it has to pass through a broker. So the broker will get you onboarded. But that broker will set up a special account for you where your fund goes into. Then if you are a self-trader, you could be able to make execution by yourself, or the broker will make execution on your behalf. It must pass through a broker. Yeah.
Thank you
It's
very much.
difficult. It's difficult for you to walk into any exchange and say, I want to. No, they'll ask you who's your broker.
Okay, thank you very much. I have Mr. Tunji. Please go ahead.
All right. Thank you, Mr. Uche. I sincerely appreciate your lecture and the depth that it has brought to us, and also the exposure. My questions are likely to be 2 or 3. The first one, I could remember some few years ago, precisely around that 2015, 16, when the market price was so low, and it got to a stage that was actually even below $20 for a barrel that time. And that was, it took the world with a shock anyway, and Nigeria was badly affected that time. And I could remember as well, US try as much as possible to push more oil out of their reserve that time, which eventually affected the market. Now, the impact of that on investment that one will have will surely be enormous. How at that point we won't be able to manage that situation, knowing fully that perhaps we want to take a short-term position in this in the market. How realistic is it vis-a-vis the long-term objective of the business? 2, what is the minimum threshold if at all you want to trade on derivative, minimum threshold, whether in terms of barrels or in terms of fund? How much will actually be needed? The onboarding process, do we actually have local firm that brokers, if I would say, that can handle that derivative market for us, knowing fully that the oil is being traded globally? Thank you.
Okay. You may need to remind me again your last question, the first question, in case I didn't get it clear. I didn't answer it clearly. Let me start from the last one. You talked about, do you have local brokers? We are working to establish a strong deal with GTI, because they are mostly local and international company. From my personal research, they are one of the biggest firm in Nigeria. So I won't call them local. They want to connect to intercontinental market. So you could be able to get on board. Remember my second to last slide, I told you about self-regulation. So some of these things are done on self-regulatory. It's different for you to be run on central regulation. No. So you could be able to get onboarded through that process. Is very simple. It's almost like opening a bank account, your ID, your name, blah, 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 all this kind of stuff. Then from there, you get boarded. Your broker may charge you a fee for getting onboarded, or a fee of the profit, like performance fee or withdrawal fee, whatever. Then you will see those terms there. Now, the second question, the value of oil. Oil is traded in barrel. A barrel of oil is about 158 liters or so. But in the derivative, is count on price, not on barrel. For example, but let me explain something to you. It takes a count on barrel, a count on price and cent. So each of these cents could represent a liter. So, for example, if oil currently, I'm not on internet now, let's say it's trading at $70 per barrel, $70.80 per barrel. If it moves $70.81, that 81 cent is the major thing, not the $70. So those cents represent a liter. That's how the profit is made in oil. That's also why it's difficult for you to hear a newcaster casting oil price without mentioning the cent. The cent matters more, not the dollar. So for you to move from $70 to $71, it has gone 100 liters, which mostly 100 cents, which is part of the profit you're making. So everything is like, let me use the word, standardized to money. You know, mathematically, you cannot have 158 before you get another one. It's either you have 10, 20 to 100, like 1 to 100, 100 to 1,000, 1,000, I mean, stuff like that. So that is what, that's how it is done and what matters. Yeah. So your first question was the prices.
Yes, the prices that happen that time.
Yeah. Now, a trader doesn't care about the price. What he cares about is to know where the world is going to and play along. GTI no more. They have a lot of investors who invest in stock and other things. The stock people does not care whether the company is doing. They just want to know if the price of that, if that company has potential, they buy the share. Once the price maybe is not favorable again, maybe they sell off their shares. They don't want to know whether the management want to go to America or whatever. No, they just want to flow along what the share value of that company is doing. So a trader doesn't care if OPEC decide to. Yesterday there was a news that speculation anyway that oil price may hit $300 per barrel in the future. JP Morgan said it's going to hit $82 per barrel. These are information. We don't care. We just want to try to know the possibility, then and connect and make the money out of the market. So if you see a news that the market is going to come down to $60, $20, we don't care. Then we reverse. So most important is you as a trader or an investor, try to understand the politics that is being played, the market structure, and the forces that can influence the investment. Then you can be able to make the right and quick decision on time. But I can tell you, it's a very much profitable commodity, very much profitable commodity.
Thank you very much, Uche. But the big question, for you to enter into this market, is there a minimum price? I think that's what some people would like to know.
Okay. Yes. You could, in our firm, we always recommend people to start with maybe 1,000 to 5,000. I'm so sorry, I can tell you some people want to start with
Naira, is that Naira or what?
No, in dollars. 1,000 to 5,000. Yeah, because it's not currency, it's a commodity. So the contract is high, and there's some of the derivative, of course, you know that it is done on margin, and which is the most simplest form of trading. So you have to trade with a little portion of that your money to make more profit. So we don't recommend people trading, coming with small amount of money. It's going to be difficult. For you to make big money in the market, you also need big capital to be able to play in the industry. However, every investor who are coming into a new business will always want to start small. So that's why we put that bench within that 1,000 to 5,000. It could be easier for them to test the market, see how it works. Then if they see that it's a very profitable thing for them, then they can be able to go in deeper.
Thank you very much. Fola, you have the floor. Hello, Fola, are you there?
Hello. Hi, yes, I'm there.
Please go ahead, sir.
Hi, Uche. I'm Nigerian. I'm currently in the UK. I've been trading for around 5 years now, and I've only recently just started to dabble in the commodity space. I'm sort of looking for advice in terms of which type of markets to trade, rather spot crude oil or futures. I only say that because I'm currently trading spot crude oil. However, I use tools such as market profile, footprint tools, and order flow, which is sort of not really transparent when dealing with spot. But I've heard that it's more transparent when dealing with futures contracts. So what would your advice be in that sense?
Future contract is far better than spot. Spot is complicated. The same way you want to deal on spot on delivery, you could see the complicated thing. Like GTI can confirm, we trade on gold. We have made some few orders on gold through HM, but if you see the complicated thing in some things, you will see that spot is a lot of complication. So if you want to be a smart investor, future and derivative is the best.
Got it.
So I don't have any issue. Your money goes into your bank. You know, since you live in the UK, you know how the financial system works. So sometimes within 3 working days, your money is back to your bank. So there's no issue be over.
Thank you.
Yeah.
Thank you very much. Okay, I'll take some questions that have already come in. Do you have a list of platforms that you can recommend that trade oil so that somebody can join? And then another question is, can technical analysis be of help when you are trading? And I'd like you to take the last one. The trading in oil, the swings and position, which is best, or is it just simply day trading? So those 3 questions, if you can just handle them. The advice on platform.
Advice of platform is illegal. It's illegal and unethical to make a recommendation of any company. It's unethical in the market. We are a trading company. If you want to trade with our company, our site, I share it there, then you could connect. with our site, with our company, and trade with it. Then, but it's totally illegal for us to make any recommendation to anybody, or let's say unethical. I won't say it's illegal. It's unethical. It's unethical practice. Yeah. Then, if you are a client of GTI Group, then I would recommend you to communicate more with GTI Group so that you could be able to guide you through, because we're talking about proper legal structure where you could come on board. Then your second one, somebody asked of swing or day trading. That is speculator. We are talking about institutional trading. Institutional trading is where the money is made, not on retail traders. Retail traders lose a lot of money. So your second question of your last question of
technical analysis. How good is it?
Swing option or day trading? Yeah, day trading. They are retail investors. Retail investors does not survive strong in the market. So institutional trading work more. And technical does not really play a huge role. What plays a huge role is the prices. The price which you bought your product and the price you sold your product is what determines your profit, not the chart. The chart only keep history of the movement, how it has been. For example, oil is very high this time. OPEC is expecting that oil price is going to close at a higher price, but we're expecting a serious drop, because it's very much easy that it will drop if case anything goes wrong. Because one thing about higher oil price can make more markets, can trigger more supply. For example, Nigeria want to leave OPEC. That was someone that make a comment that Nigeria should leave OPEC. They give us 2 million barrels to supply, and we need more money. So so I imagine if we started selling from the black market or move, then we could be able to sell as much quantity as we want. And the one that are more supply at a higher price, then the price will drop. So we don't care. All of them present opportunity for us. So we are already positioning ourselves to make profits from the drop. It could drop at any time. Then another question is oil price option best way to trade? Okay, swing position. I think I've answered the third question, right? Yeah, I've answered the third question.
Good question. Okay, there's another question here. Is if I want to get into this oil trading, do you have classes that can train people on how to trade?
GTI Finance Academy is, as you can see, it's already an academic arm of the company. So they could proper organize training for you. For me, it's difficult to teach you because we are a trading firm, so we don't really have educational arm. We are much focused on trading. It's trading that we do. So teaching students is kind of stressful. It may not be something we do. We don't always do it, but we do seminars once in a while to let people know how it works. But we may not be able to give you a proper education on how to trade unless when you are our in-house trader, then we could teach you how to trade all this things, or refer you to institute like Chartered Institute of Nigerian Stockbrokers if you're in Nigeria, or Nigerian Commodity Exchange to train you. Then you can come back to us for executions.
Okay, basically what that means is that you have positions, because somebody actually asked if your firm has open positions for traders.
Yeah, we recruit traders once in a while, but the market is huge and account is much. So there are two people we try to avoid, or we try to securitize. So you see, those who trade on forex market, who have been on the retail value, they don't also understand how institutional market works. So if you bring them in, you need to start giving them proper training, orientation, try to let them understand how you should play on this one. So now, if we recruit from retail traders, bring them back to institutional, try to change their narrative, or we get new people who just probably have understood how institutional market work, and we play on, because as you know, GTI, we play on both sport and future. So there are sometimes the way we are moving now, we want to even move into bigger future market. Sorry, bigger future delivery market, because of the food crisis and other things that's going across Europe and Africa. So we mostly like to work with those big guys who already have the idea of institutional executions.
Well, I don't know if you can take this, but I think I'll just ask you. Somebody also dropped here is the saying that what kind of returns will somebody expect, say, over a 6-month period when working with you?
It's unethical and illegal to give you a return. Nobody does that in a genuine business. So market determines. I've already told you the kind of profit. I shared this slide with you. The profit, the kind of brokers profit this 2021 from Yahoo Finance. I don't know if I can share the screen again. From Yahoo Finance alone, how much profit that was able to Yahoo Finance has about how profitable is oil. Yeah, Yahoo Finance alone, the brokers globally last year, the volume was $535 billion. Then this year they're expecting to have about $469 billion. And of course, the derivative markets volume is over more than 1 trillion, per trillion. Sorry if I can't pronounce it correctly, just forgive me. Then our firm, we made, look at the profits we made on one of the portfolio on our firm. I can't come and give you a figure. It's totally unethical to give you a figure. I can only tell you that the market is very profitable. It is when you are doing the business, you will now know whether this thing they told you is actually true or not.
Thank you very much, Uche. So the floor is open. Do we have any more clarifications or any questions? A lot of people have asked for the presentation. We're going to be relating with him for that, and also for the recording. For the recording, we're going to send you the link. It's going to be uploaded on our YouTube page so that you can always watch it at any time. So that will be circulated to everyone who has registered for this webinar. So do we have any other questions for Uche? Okay, I think we've had a very, very good session. So I'll just let Uche please give us a roundup, or just give us your closing remarks so that we can bring this to an end.
Yeah, first of all, I would like to appreciate those who are here. There are quite a number of them: Mayoma Green, Tunji, Sadiq Ibrahim, Research GTI. There are quite a number of them: Oluwafemi, Olaide, Namde, Folu Benjamin, quite a number of them. Adetuji, Agnes, Ali Abubakar Dashima, so many of them to be. So I want to congratulate you for I also appreciate you for sparing 1 hour, 15 minutes of your time to be here. And I still want to encourage you to be part of the business. It's a business that when you go into it, you will definitely not regret into it. So you will become an oil dealer or oil investor, or make money in the same oil market by yourself without having to go into all the oil licensing and everything. Just become an oil trader. It's a very nice thing to be a commodity trader. So it's a very big business that I will encourage you guys to be on it. It's also an avenue to make more revenue into the country. Like, for example, if you do your research where you are now, you can do a research about hedge funds in the United States or in the Europe, how much they generate. Some of these hedge funds generate maybe average, let's say 15% per annum or 20% per annum. And at the end of the day, they generate like $30-something billion, $68 billion, $90 billion profit into their country. Now, that is how this things work. So you see that so many big firms are making money. Imagine if there is a firm in Nigeria who trades on the global market that is able to generate, let's say, $100 billion per annum, because we have the money. We actually have the money. There are a lot of investors there. $100 billion on the derivative market back to the country. Do you know the kind of impact it will make in the economy, the kind of job it will create and everything? This is how globalization works, where you have to make that money into your own country, bring in that money. Instead of giving it out, you stay in your country, trade on, let's say you trade on an exchange in Australia and the one in Dubai, for example, and at the end of the year, your derivative position in oil has gained $50 million. That money is going to come to your bank account in Nigeria. So that is a very big investment that people need to go into. We need to encourage the derivative market. We need to diversify it. We need to make sure that investors are aware of it. I also want to congratulate GTI for making this training possible. It's a very nice one, and I think we have learned a lot from it. Thank you very much.
Thank you very much, Uche. We really appreciate your time and the wealth of experience that you've brought to this. I know the conversation will continue, and I'm sure some other people will have more questions, which we can take offline. Thank you very much, Uche. We will be circulating your contacts. So please, if you get messages from our wonderful audience, please also help us to respond to them. Like he said, we are GTI Finance Academy. We are part of the GTI group. We're an investment banking group that covers asset management, securities trading, private equity, and finance. So we are in Nigeria, and we want to ensure that not only do we bring financial literacy to the average Nigerian, but also create various opportunities for which people can actually make very solid investments and have good returns on those investments. So I want to thank everyone for coming. Like I said, we'll be communicating back to you via your emails, giving you the slides and then the link so that you can rewatch this over and over again. Serious information has been shared. And if you have questions thereafter, please just get back to us via email and via contacts. And we'll be over.
Please, I dropped the question. No one has answered.
Hello, sir.
Yeah, I dropped a question in the comment section, but I don't think there's a reply to it.
Okay, can you quickly take that question so that we can shut down immediately?
Okay, so I asked the question. So can I repeat the question?
Please go ahead, yes.
Okay, so I asked a question to Mr. Chair about swing trading and the difference, how good it is. Is it specializing on swing trading or day trading? And he said that's for day traders and not for institutional traders. So the quick question I have here is, what's the main difference between the institutional traders and the retail traders?
One, institutional traders.
You have 1 minute. So okay. Sorry.
Yeah, one, institutional traders trade on a long time goal and they trade directly on their liquidities. Some of them trade directly in-house, while retail traders trade mostly on a short-term goal or like on a short time. For example, you may see a retail trader that will place a trade within a week, the person is off the market. Institutional traders trade on a very long time and they trade on a lower risk. So an institutional company may be targeting only 15% return per annum. They will be targeting 40% return per annum. It is difficult for you to see a retail trader who want to target even 15% per annum. It's difficult. They want 200% that day. So they are more exposure to risk and they speculate a lot, while institutional trader does not speculate. Maybe make it as a research for you. Just go different between retail investor and institutional investor. Then you will see a lot of differences. It's totally opposite of what you are doing. That's why retail traders lose more money than institutional traders. It's opposite. If you play the opposite, then you make more money.
Thank you very much. We'll continue to have this conversation with you, and we really appreciate your time. So please, if you need more clarification, you can always reach us via our emails and all the other contacts that we have displayed. So once again, I want to say a very big thank you to everyone who has come in. It's been a very fruitful an hour and a half that we've had. And Uche, thank you so much. I'm sure this is the beginning of the better relationships, which I have more interactive sessions like this going forward. So to every one of us, thank you so much. And please do have a wonderful rest of the day. Have a lovely day. Bye now.
Bye-bye. Bye.
Bye.